Let's bring in former Dallas Fed President Richard Fisher. He is a CNBC contributor, and we should note he was also a deputy U.S. trade representative from 1997 to 2001. Richard, you've got it covered here on multiple fronts. You heard that the way Steve characterized the consensus out there among economists of what might be the impacts: less growth, more inflation at the margin. Does that fit with the way you're thinking about this, and how would a central banker respond?
Well, first, think of how a woman or a man that runs a business reacts. They're getting a tax, raising the price of their inputs, and they have to protect their margins. So, Mike, it's common sense that they'll try to pass on those new pressures to their customers. And the question is, do they do it all at once? Do they do it in a gradual way? How much do they do? How much can they get away with? So common sense, which the president likes to quote, tells you that it would be inflationary. But keep it in perspective, the average applied tariff presently, before these announcements, is 2.7%. But you're looking at the largest exporter, which is Mexico, second largest China, the third is Canada. Together they represent about 41% of what we import from overseas or across our borders. So clearly, if you maintain this 25% for both Canada and Mexico, another 10% for China, it's going to have an inflationary impact. The question is, do businesses respond by slowing down? And as far as the growth is concerned, most economists feel it is dampening to growth. My own experience as deputy USTR, because whether they're Republican or Democrat, every administration always, of course, provides protection for steel, for example. And we knew in the Clinton administration, as was true for George H.W. Bush and others, that what it cost us to protect a worker was greater in terms of its impact on the taxpayer and on the economy. So we know they're inflationary. Now, as to whether or not this is a good negotiating strategy, that's another story. Steve just said they're focused on fentanyl. Kind of ironic, by the way. There would not be a tariff on the imports of fentanyl that the syndicates or the bad guys in Mexico perpetuate. And I grew up in Mexico. I was a trade negotiator with Mexico. Spanish is my first language because I grew up in Mexico. I know the economy well. Putting 10,000 troops on the border, my guess is they will be infiltrated by the syndicates. There certainly will be a lot of effort on behalf of the drug gangs to make friends with the federales, who are going to be charged, to 10,000 of them, with ferreting out fentanyl. So you have to keep these things in perspective. And maybe that's why the president gave him 1 month, just to see if it would actually work. We'll see.
Yeah, and unclear, too, just how much that changes the overall numbers at the border and all the rest of it. But, Richard, I guess the question is, this all comes at a moment when the Federal Reserve is, in a sense, comfortably on hold, obviously wanting to wait and see. They've paused in their rate cuts. They want to see some of the data and the policies work their way through. And so it feels as if, at least based on how Jay Powell characterized things last week, they're at a spot where they don't really see huge risks to doing nothing. Is that fair? Yeah, and I was fascinated. Was it this morning or yesterday where President Trump said he agreed with their decision? Yeah. That's news. I'll tell you that, because he rarely agrees with Powell and the FOMC. Look, the real issue, Mike, isn't the real issue here is, what does the Fed control? And I'm going to give you a quick numerical breakdown. The federal government last year, fiscal year just ended in October, took in $4.96 trillion in revenue. That's taxes and fees. They paid out almost $1 trillion in interest. So imagine a business that 19 or 20% of their intake goes to paying interest. You wouldn't invest, none of our viewers would invest in that business. Now that cost is going up because the 7 and 10-year treasuries that were financed at 2% are now going to be issued under Secretary Bessent at 4.5% or 4+%. My point is, the cost of carry is going up. Right. The Fed does not control that. The Fed does not have any control over the yield curve, I believe, beyond, say, 6 months or 1 year max. And if you look at what happened since they cut rates in September,
the rates in that part of the yield curve, 1 year out, 2 years out, have all risen significantly. Why? Because the supply-demand factor with the Treasury. And
Yeah.
I'm very much looking forward to see what the new Secretary of the Treasury and the President does to bend that curve. But so far, we haven't heard any discussion of it whatsoever.
Yeah, for sure. No, market yields on the longer end up quite a bit from that first rate cut and even December, but definitely off their high.